In this presentation, we will take a look at how to set our sales price using our cost data. We'll take a look at this in a few different ways. We're going to first start off with the total cost method. So we have our cost data, we have our inventory costing. We then want to use that to create or make what we think our sales price should be. So of course, one way we could do that is say, how much does it cost per unit? And then have a markup on that and say, this is what we need to have in terms of our profit from the cost basis. We can do that one with a total cost method. We can figure out what the total cost is per unit and then select a markup. Now, in order to do this, of course, we're going to have a markup percentage that we're going to have to mark up on the total cost. We're going to have to figure out what the total cost per unit is. And we need to be aware that to have the total cost per unit, we're going to be applying out overhead fixed costs. In other words, we're going to have to be combining costs together that don't act in the same way, variable costs and fixed costs. To do that, then we typically need to know the number of units we're going to produce, because the fixed cost, the amount that we allocate, will differ based on how many units we make. So that's a problem with this type of method, because obviously the cost per unit, the total cost per unit is not really exact, or it will change with regards to a changing level of production on it. So we're going to get the total cost per unit, and then we're going to figure out the increase of the 10%. So here's the steps we're going to take. We'll figure out, here's the variable costs, we'll figure out the total costs, and then we'll figure out the total cost per unit, and then we'll mark it up by the 10% to find out what we think we should sell it at per unit. All right, so to do that, we're going to have the variable items that we have within our information. That's the 109, the 39, and the 54. These are going to be the variable costs related to our unit of inventory. These are going to be the fixed costs with relation to a production level at 10,900. So this is how many units we're going to produce. Variable costs will, of course, go up at a variable or a fixed rate as we increase production. So we're going to take that 109, the 39, the 54, multiply them all times the number of units that we're going to produce. 10,900, that's going to give us our totals. So we have the variable costs in total, 1,188,1, 425,1, and 588,6 with regard to materials, direct labor, and overhead. So these are the per units, these are the total numbers. Then we're just going to add to that our overhead. So we've got the fixed overhead, fixed selling, and admin. These are our fixed costs. We're going to put them in the outer column, noting that the fixed costs don't really change with the level of production. So we're going to have to put those in place, and then we're going to have to apply out the number of units to the fixed costs. So those are the things that kind of mess up our calculation, because with a different type of production level, we would come up with a different total cost. So if we add all these up, then the total cost, if we add up this outer column, 2,964,800. That's our totals. Now we're going to use that to create our selling price. So we're going to take those total costs, we're going to divide them by the number of units, which is 10,900. That's going to give us our cost per unit. So our cost per unit is 272. That's what we think it's going to basically, obviously, cost for each unit. Now we just need to take that number and put a markup on it. Now the markup is 10%. So we're just going to increase the 10% for the markup. So we're going to say the markup is going to be 27, which is 272 times 10%. To give us the price of the 272 plus the 27, or the 299. Now notice when you get to that markup, you may just want to consider the fact that, of course, we can calculate that a couple different ways. We could take the 272 times 10%, or 0.1, 27.2, so that has rounding involved here, so we didn't include the rounding, notice. And then we're going to say 27.2, and then we could say plus the 272, and that's going to give us the 299. It's actually 299.2, so keep that in mind. And then we could also do that with one calculation here. We could say, okay, we need 100% plus the 10%. We can go directly from the 272 times the 1.10, or 110%, 1.1 or 1.10, 110%, 100% plus the 10%. That's going to give us the same 299.2. So it's useful just to keep that in mind, keep that kind of calculation in mind, however you want to write it or think about it. Okay, so now we're going to look at a variable costing method. The variable costing is going to be an equation. Let's look at the equation first. The markup percent is going to equal the target profit plus the fixed overhead plus the fixed selling and admin. In other words, it's going to be kind of similar to our break-even kind of calculation where we have the fixed costs plus the target profit, what the profit we want to make plus the fixed costs. We're going to divide that by the total variable costs. So here's kind of the difference we have here. The break-even would be divided by the contribution margin. We're dividing here by the total variable costs. That's going to give us our markup percentage. Let's look at a typical type of problem related to this. We're going to have the direct materials, 114, the direct labor, 39, variable overhead, 49, fixed overhead, the 348, 312, fixed selling and admin, 251, and target profit, 220,000. Estimated units that we're going to sell, 10,400 units. So first we're going to take these variable costs. So these are going to be the variable costs up top, the 114, the 39, the 49, the direct materials, direct labor, and overhead. If we total that up, they're going to come out to 202. We can multiply that times the number of units. So here's the number of units, 10,400 units, times each of those variable items. So we could break that out into each variable item. Total costs for all variable costs, just variable costs, not including the fixed cost, 2,100,800. Then we're going to consider the markup percent. So we've got the target profit is 220,000. Then we're going to take the fixed overhead, which is the 348, 312, and the selling, the 251. So remember, that's going to be our target profit. That's what we want to make, the 220, plus the fixed costs, which we broke out to fixed overhead and selling and admin. That totals up to 819,312. We're going to take that amount and divide it by the total variable costs, which of course we calculated down here, and that's going to give us our markup percent. So in other words, we took the 819,310 divided by the 210,800, and we got something that's not even. So notice that it's about 39%. We have rounding involved there if we move the decimal over 2 places. So the selling price using the variable cost method is going to be the variable costs, which is the 202 that we calculated over here, all the variable costs per unit, plus the markup. And the markup is going to be the 202 times the 0.39. So 202 times 0.39, and notice this is rounded, so about 78.78. So the variable cost, the 202 plus the 78, the 78.78 is the 280.78. Now we could go ahead and check this number if we pull out the calculator here and say, okay, does this work if we had the 280.78 and we said that we're going to sell 10,400 units times 10,400? That's going to give us the 2,920,112. If we take a look at our costs, we have the variable costs over here, so minus the 210,800 minus the fixed costs, not the target, but these two items, minus the 348,312 minus the 251,000, the fixed costs. That gives us our target, which was the 220. So you kind of check your work with this type of calculation as well.